Hey, what's up, guys? It's Sam Hartman, Keeping It Real Estate. There's a lot of craziness going on in the world, and it's hitting the lending market as well now. So I've got Seth Bennett with Hallmark Home Mortgage here to talk a little bit about what's affecting the lending industry and what that means for our real estate market. Stay tuned.
I keep it real, I keep it real, I keep it real, just keep it real.
Video here.
Yeah.
All right. Hey, what's up, guys? I am live Saturday morning here with Seth Bennett from Hallmark Home Mortgage. And yesterday evening, I received an email update from Seth of some really unique things that were happening in the lending industry. And I called Seth in the morning. I was like, hey, you want to hop on a video call that we could try to get some of this information out there, fill people in on the specifics of what's happening, but also maybe a little bit of what's going on in the background and what that might mean for home buyers, home sellers, people refinancing, and just how it's affecting our housing market as a whole. So with that, I'm gonna introduce Seth Bennett with Hallmark Home Mortgage. Hallmark Home Mortgage. Got him on the line here. Seth, welcome this morning. We've got our hats on, our beards are growing longer. Our hoodies are smelling worse and worse as the quarantine continues. How are you doing this morning, man?
I'm doing great, man. Making the most of it. Yeah, you're right. Just wearing the Saturday morning attire, but making things happen the best we can.
Absolutely, absolutely. So with that setup, I mean, you sent a pretty comprehensive rundown of what's happening in the world of lending. Do you want to kind of review that for everyone on video here, and just kind of go through the line items of what's being affected right now?
Absolutely. And before I sort of get into those details, one thing that I didn't put in my email, and I probably should have first, was, if you're a well-qualified conventional borrower, nothing so far has really changed to impact you.
Mm-hmm.
And there's some minor tweaks, concerns, things, yes, but those were always there in regards to, maintaining employment throughout the loan process before closing. So when you just look at your good conventional borrowers, they have nothing to be worried about. So there's one sort of positive, if you will, before we get into some of those changes. But
well, and to add to that point real quick, Seth, I mean, our market's been so competitive for so long that those are the types of buyers that have been winning deals anyway. So those are the buyers that right now with this change are least affected, and the loan products and stuff that you're going to talk about here, maybe those buyers that are a little more on the fringe that maybe aren't as strong as lending options. And probably in this economic slowdown for the time being, they're going to be the ones that are most affected with their ability to purchase anyway, right?
Right, and it's interesting you bring that up because you look at just economics and to a degree, and for the last 3 years, I think probably when we hit that spring market, you know this as well as I do. If you're an FHA buyer or a VA buyer and you're in a multiple offer situation, and there's a conventional offer on the table that's similar or very comparable, and from my experience, sellers are taking those because of it's, so to speak, a better borrower, a more likelihood for that loan to go through smoothly.
Yep.
So when you say that, like just the seller mindset, that's almost being applied now in the mortgage industry, where lenders are saying, hey, we don't necessarily want to be doing these loans right now because the added layers of risk.
Mm-hmm.
Same thing, a seller in their mind has already determined there's added layers of risk involved with that offer. Why don't I go with the conventional? So it's just, now it's being kind of pushed through our industry due to all the coronavirus changes.
Yep.
Hey, we don't know if we really want to bite off these riskier loans, if you will.
Gotcha.
For the time being.
Okay.
Permanently, just for the time being.
Sure, and you were pretty honest about that, in your email here that I got pulled up. It's like, this is the way that it is right now, and our times are very fluid right now. Things are changing day to day. One day we were, going to restaurants and going to grocery stores and living life as normal, and the next we're quarantined with our wives and our dogs and our kids inside, and life is quite different. So obviously these things can change really quickly, but that's why I wanted to hop on a call with you here first thing on this, because this information is going to change quickly, and as it changes, I'd love to do this again too. So why don't you hop into those loans that are being affected, how they're being affected, and stuff like that?
Yeah, the biggest one, which is just because the nature of the loan program and the amount of people that utilize this, is FHA. So pretty much all lenders have already raised their minimum credit score requirements to 660 on that. And to be totally honest with you, it's not yet pushed through FHA or HUD, which is directive from the federal government. But I have heard from reliable sources that starting next week, FHA, VA, USDA, all of those loan programs are going to institute a minimum 660 credit score. So VA prior to this, technically had no credit score requirement. FHA was really 580. USDA, you really wanted to be above a 640, but you could get away with down to 620, and they actually had non-traditional credit. Well, all that stuff's being shelved for right now. That's going to affect people the most. So, there's a lot of buyers that I want to say are good buyers, but they have a 640 credit score. Well, starting next week, they're going to have to probably work to increase their credit score in order to obtain a loan during this time. So that's the biggest change probably. I want to say that's rolling out. Some of the more peripheral loan programs and options that people take advantage of are also getting impacted. So one is the jumbo market. So in Indiana, that's anything over 510, I think 400 on a loan amount. Those loans right now pretty much are being suspended, meaning you can't start a new loan application is the best way to put that so the consumer understands. There are some options. There are some depository institutions that are still doing that, but at least from experience, it's going to be a rough, brutal process for that borrower because it's a riskier loan, and most lenders are probably going to be extra diligent and crossing every T, dotting every I. Not that we don't already, but I would suspect that that's going to be a big portion of that.
Why is that? Why are they shutting down jumbo loans? Like what's the reasoning behind that? You would think if someone can afford a large loan, they're probably pretty financially stable throughout this, you would think. So what's the thinking behind that?
Yeah, no, that's a great question. And here is probably the most simplest answer. When you get into jumbo loans, lenders can't take out mortgage insurance and require you to take mortgage insurance. The lender has to bear all the risk. And so when you have no protection as a lender in the event that borrower defaults, it's that lender that's stuck with the foreclosure process and all of the fees, and they don't get to recoup anything, so to speak. So it's a huge risk in that aspect. But you're right. Most jumbo borrowers are very well qualified, but it's that mortgage insurance layer of risk where it's, hey, let's mitigate that for right now.
Gotcha. Okay, that makes sense. And so from the FHA side of things, what does that mean for our real estate market, locally, nationally? I know a lot of people, I put out a video the other day talking about, are we heading towards a recession, and what does a recession mean, and what does that look like? But one that I'm working on putting out this week is, are we looking at another 2008? So I think a lot of people fear that because that's kind of the recency bias of our last recession is it was a housing recession. In my opinion, when I see something like this, it's almost trying to get ahead of putting at-risk borrowers into the market. So it's almost kind of protecting and hedging against some of those maybe high-risk defaulters and potential foreclosures that would be coming down the pipeline in future months and years and things like that. So what's your take on that and how that might affect our housing market?
Yeah, I think you hit the nail on the head there. This is totally different than 08. 08 was the mortgage industry and housing industry on the front end. I don't want to say caused the recession, but to a degree did have a big impact on the recession, and it also lasted for like 4 years. It started really in 07, and we really didn't start to really come out of that until 2011. Well, during that whole 4 years, all you saw on the access to credit was it just got restricted. And then from 2011 really up until this week, what you saw was expansion of credit. So you got to a point to a degree, and I mean, this is kind of a joking way, but it's like you got to a point where almost anyone could qualify for a home. I mean, you had all the down payment assistance, you had all the low credit score, and you had everything. It was very easy to get a borrower qualified, which was great. You know, that's helping people obtain home ownership, and in many cases, you know, your mortgage payment and home ownership is a better financial future for you, whether that be a lower payment or you're building equity. So, in regards to how it affects our local market, you know this as well as I mean, we've been one of the hottest real estate markets in the country going on 2+ years. And so really what that means is that we have this huge excess of buyers from an economic standpoint relative to the amount of listings and homes for sale and sellers out there. So I think if you compact the buyer pool and weed out half of them, I don't know that that has a huge impact on our market because you've still got a lot of well-qualified people out in the market. And so if anything, maybe you see a move to a more balanced market. That's, you know, obviously you guys know that, but that's my opinion on that. I don't think it's going to locally have a huge impact on us. I think you could see it impact some of those more volatile markets, you know, Southern California, you know, all of those places where there's a lot more risk involved there.
Yeah, from my, you know, from the realtor broker side of things, I totally agree with the potential effects on our market. I've had this conversation with a lot of clients right now of what our market looks like on the backside of all this. And obviously, like you said, that buyer pool is going to be constricted a little bit, but our buyer pool has been how big for how long? I mean, we've been running on 2 months supply of inventory of homes, which, if you don't know, is really, really low. An average supply, an average equilibrium market would be a 6-month supply. So that's 4 months below an equilibrium buyer-seller market. That now we're going to shrink that buyer pool, but golly, like sellers were only wanting to deal with those conventional offers, those cash offers anyway, and a lot of times. So maybe there's a certain price point that might be affected in our industry, you know, that was mostly accessible to those FHA, lower credit score type of buyers. But gosh, in the grand scheme of things, I think people are going to come out the backside of this pandemic and this quarantine with a head full of steam, ready to buy, because we've been cooped up. We're putting things on hold. I know real estate is still considered an essential industry right now, but it's definitely affecting our market. I mean, showings have dropped off hugely, which they should. People should just be going out flippantly looking at houses, whether they're really into the market or not. You know, it makes sense to kind of defer things, especially with some of the uncertainty with the lending industry now too, with some of these things as well. So no, I totally agree with you there. I think Fort Wayne, the good thing about Fort Wayne, even in 2008, you know, our peaks and valleys are more like rolling hills rather than mountaintops. You know, we aren't ever too high, we aren't ever too low. So we kind of survived 2008 a lot more feasibly in a lot better situation than a lot of, you said, those coastal vacation type locations that, you know, people were owning second homes, vacation homes, stuff like that. People were over leveraging themselves to afford these really expensive homes. So that's one of the really nice things about being in such a conservative Midwestern market, is that, you know, our peaks and valleys aren't too high or low. You know, we're pretty conservative. You know, if we do take a hit, it's pretty minor. Actually, our growth has been phenomenal. It's kind of been much needed over the past, 4 years that we've had a hot market. We've been growing like crazy, and yet we're still ranked one of the most affordable markets in the United States. So that just goes to show how conservative our market has been and how conservative it still is going forward. I mean, we're still a value in the grand scheme of the United States real estate market. So awesome, Seth. Do you have anything else to add? I really appreciate the context that you're given to this situation and what's happening in your world, and I can take this information and apply it to what's happening in my world too. So I really appreciate your time this morning.
Yeah, I think probably maybe the only other thing I would add is with the sort of contraction of some of these more riskier loans, as a community and as a homeowner, you in a way should embrace that, because what lenders are doing is trying to protect the industry, which protects ultimately their home value.
Yeah.
Because you get a high rate of foreclosure, everyone knows what happens to the values in the neighborhood. And so, instead of doing these, what were called NINA loans, no income, no asset in 07, 08, which really caused that, here we are totally different. We're getting rid of even traditional loan programs or tightening the restrictions, ultimately to protect the values of homes. So I think everything you said was great. I think we are going to see things continue to move, and I think once we clear the pandemic, it's really going to take off.
Yeah, that's awesome, man. I appreciate it. I love that you always have a positive attitude and outlook on things. I know at default I can be always positive, so I'm trying to get information from people and try to look for the other side of the coin through this, but I keep coming back to positivity. I think this is an event that has got us really slammed and down right now, but I think anytime an event puts America down is, we rise up and we come to meet the challenge, and we'll be back to a great spot probably a lot sooner than people maybe think right now, because things feel so bleak. So appreciate your positive outlook, appreciate your time this morning. Enjoy the extra family time and the extra home time with the kids and the wife and everything like that. Hopefully everyone else is taking this time to better themselves and enjoy their time at home, but really appreciate it this morning, man.
Yeah, my pleasure. Appreciate you giving me a call, and same to you. Enjoy your time at home, enjoy your weekend, and we'll talk to you soon.
Absolutely. All right. See you guys.